In most cases, investing for beginners often starts with one promise: invest small amounts daily and retire wealthy. But here's the brutal truth. Most investors end up trapped with impressive portfolios they can't actually use. Big numbers, zero cash flow. For instance, investing in the S&P 500 isn't a bad idea because it's actually one of the most reliable ways to build long-term wealth. It offers stability, steady growth, and exposure to America's strongest companies. But here's what most beginners don't realize. While the S&P 500 is a great starting point, it's not the most efficient path to financial freedom. If you look closer, and you'll see why. For instance, nearly 40% of the index's performance comes from just 10 massive tech stocks, meaning it's not as diversified as it seems. You're essentially betting your future on Silicon Valley. And when it comes to cash flow, the S&P 500's dividend yield barely breaks 1%, which means even a $1 million portfolio only pays about $11,000 a year, not exactly enough to replace your income. So, yes, the S&P 500 can grow your wealth over time. But if your goal is to live off your investments, there are smarter strategies that balance growth with consistent, high-yield income. In this video, I'm revealing 3 game-changing ETFs that flip the script entirely. These selections harness compound interest while simultaneously paying you to own them. They have the potential to deliver $700,000 in extra total portfolio value versus standard benchmarks, plus over $15,000 in monthly dividend income that exceeds most full-time salaries. Ready to make your investments work as hard as you do? Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Now, before revealing these specific investment strategies, let me share the 5 filtering rules that separate genuinely strong ETFs from the thousands of pretenders. The ETF investment landscape is deliberately overwhelming. Fancy names, aggressive marketing, charts always pointing skyward. The truth is that the real power of ETF investing isn't about chasing trends. It's about choosing proven structures. For instance, when I was building this system, I ignored popularity and focused on principles that have withstood every market cycle. First, the ETF must pay you for ownership. Second, that income must grow consistently. Getting paid once is pleasant, but annual raises build genuine freedom. Third, steady price appreciation multiplies the compounding effect, transforming good portfolios into wealth-generating machines. Fourth, operational efficiency matters. Finally, true diversification means different sectors, geographies, and business cycles, balancing each other like precision gears, not 500 similar companies masquerading as variety. When yield, growth, appreciation, efficiency, and diversification combine, you create investment strategies that compound exponentially rather than incrementally. This is how to make money while actually enjoying your life, not just building numbers you can't touch. Now let's dive into these special ETFs. We'll start with the foundation builder. Listen, every structure needs bedrock, and in this portfolio management system, that foundation is the Schwab US Dividend Equity ETF, ticker symbol SCHD. This fund embodies one crystallized investing for beginners principle. Own America's strongest dividend-paying companies with proven track records. No speculative ventures or temporary darlings, just established profit machines that survive and thrive through every financial crisis. Look inside SCHD's holdings, and you'll find AbbVie, Lockheed Martin, PepsiCo, Merck, and Chevron, the same titans that carried American portfolios through recessions, interest rate chaos, and market meltdowns. The sector balance demonstrates why this ETF works so reliably. 19% consumer defensive stocks providing stability, 18% energy capturing economic growth, 16% healthcare delivering necessity-based resilience, 10% industrials offering cyclical exposure, and under 10% technology, adding modern innovation without overconcentration. This mix delivers growth without gambling, income without sacrifice. The numbers reveal SCHD's true power, currently yielding 3.9%, nearly quadruple the S&P 500's 1.1%. This investment delivers immediate cash flow. But here's where compound interest becomes your wealth-building weapon. SCHD's dividend payout has climbed at a remarkable 10.43% annually over the past decade. Your income isn't just keeping pace with inflation, it's crushing it. Every single year, you're essentially awarding yourself a substantial raise without negotiating, without promotion anxiety, without office politics. Next, we are adding global balance. With income secured through SCHD, the next layer requires geographic diversification. Enters the iShares International Equity Factor ETF, ticker symbol INTF. This ETF is designed for global reach beyond American borders. While SCHD dominates U.S. dividend territory, INTF spreads capital across hundreds of established European, Asian, and Canadian corporations. Your portfolio management no longer depends on single-country economic performance, creating resilience against regional downturns that historically devastate concentrated positions. INTF holds nearly 500 companies spanning continents, such as Novartis, Nestlé, ASML, and SAP, global powerhouses that thrive independently of American market conditions. When domestic stock market momentum slows, international strength compensates. The sector allocation emphasizes durability, 25% financials, 19% industrials, and robust exposure across consumer cyclical, healthcare, and technology. This balance means tech sell-offs get cushioned by industrial stability and banking resilience, smoothing volatility without sacrificing returns. The brilliance of this ETF lies in its methodology. Rather than passively tracking indexes, it selects companies using proven success factors, robust balance sheets, stable earnings, sensible valuations. This factor-based filtering eliminates speculation, retaining only businesses built for consistency. The 2.78% dividend yield appears modest until you examine the growth trajectory. An extraordinary 19.36% annual dividend increase over the past decade. That's how to make money through strategic ETF investment, not lucky timing. Risk metrics confirm INTF's role as your stability engine. With 16.8% annualized volatility among the category's lowest and no single holding exceeding 2.5% concentration, this fund delivers exactly what balanced investing for beginners demands. But foundations and stability alone won't create life-changing wealth. You need acceleration, innovation capture, and growth that fundamentally reshapes your financial future. And that comes next, but ensure to stick around, because in the end, I'll reveal how combining these three ETFs creates a portfolio management system that outperforms the S&P 500 by adding an extra $700,000 in total value while generating over $15,000 monthly dividend income that surpasses most full-time salaries. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Let's discuss our third ETF, the unique growth engine. The Fidelity MSCI Information Technology Index ETF, ticker symbol FTEC. This ETF delivers concentrated exposure to America's technology powerhouses, driving global innovation. These include NVIDIA, Microsoft, Apple, Amazon, Meta, Alphabet, and the companies reshaping artificial intelligence, cloud computing, cybersecurity, and digital transformation. This isn't a defensive investment strategy. It's pure offensive growth, capturing the stock market's most dynamic sector. With technology representing the overwhelming majority of holdings, supplemented by select communications and software leaders, FTC targets capital appreciation over income generation. The dividend yield sits modest near 0.7% because these corporations reinvest profits into research, expansion, and market domination rather than distributing cash. What FTEC lacks in immediate income, it compensates through superior price appreciation. Over the past decade, FTEC has delivered exceptional annualized returns while maintaining a lower expense ratio than competing technology ETFs, critical for maximizing compound interest effects over time. Volatility hovers around 24%, making it the most dynamic component of the trio, but that's precisely the point. SCHD provides income reliability, INTF delivers international stability, and FTEC supplies velocity and momentum. When these three investment strategies merge, they create synergy that transcends simple addition, balancing each element's strengths against others' limitations. Now, let's quickly examine the performance that proves the strategy. Every investment strategy faces one definitive benchmark, the S&P 500, represented by SPY. It's the standard by which all approaches are measured. But what happens when this carefully designed trio confronts that gold standard directly? The past year delivered relentless market turbulence through inflation pressures, aggressive rate hikes, and supply chain disruptions. Yet FTEC dominated, posting approximately 21% gains, propelled by explosive growth in the artificial intelligence and technology sectors. INTF contributed strong 15% returns, benefiting from international market rebounds and financial sector strength. SPY achieved a respectable 13% performance, which is solid, but it's trailing both FTEC and INTF, while SCHD consolidated. FTEC and INTF compensated, maintaining overall portfolio momentum and balance. Extending the timeline 5 years reveals even more compelling evidence. FTEC more than doubled capital with a 104% return, while SPY posted about 89%, and SCHD and INTF posted consistent 37% and 43% gains through dramatically different market conditions. Blended strategically, these three ETFs create something SPY alone cannot replicate: simultaneous offensive and defensive capabilities. When growth stocks surge, FTEC leads. When global markets strengthen, INTF contributes. When volatility strikes, SCHD's dividend foundation cushions turbulence. Rather than depending on single market or single style exposure, this finance framework delivers smoother, more resilient long-term growth, leveraging compound interest across multiple economic engines simultaneously. Now, let's unite these components into one cohesive, intentional investment strategy. The structure remains elegantly simple: 40% SCHD, 40% INTF, and 20% FTEC. Each allocation serves distinct purposes, while together covering every pillar of sustainable wealth creation. Well, they say numbers don't lie. So let's project how this 3 ETF portfolio compounds across 3 decades. Imagine starting modestly, just $10 a day, nothing extraordinary, pure, steady consistency. By year 1, total investment reaches approximately $3,650, establishing the foundation for exponential future growth. By year 10, the balance is projected to be roughly $65,000, with annual dividend income approaching $2,000. By year 20, the portfolio reaches approximately $324,000, with dividends climbing toward $20,000 annually. Reinvested income now generates its own returns, and compound interest enters the acceleration phase, where growth snowballs dramatically. Fast forward to year 30, and the portfolio value projects to $1.84 million, with annual dividend income exceeding $187,000. That translates to over $15,000 monthly dividend income, surpassing most full-time salaries without trading your time, health, or freedom for that paycheck. As we wrap up, I want you to remember that financial freedom isn't about luck. It's about consistency, patience, and letting time do the heavy lifting. Whether you're starting with $5, $10, or $50 a day, every dollar invested is a seed for future independence. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.